Stuart, I'm curious to hear your thoughts on how this raises the stakes, if at all, for that CPI release that we're going to get later in the week. Because one of the things that freaked the bond market out, which, Nal, you identified last week, was that rise that we saw above expectations in average hourly earnings. And with that in mind, I mean, this market, these traders have been so content to just sort of ignore inflation, say that's mission accomplished, but maybe not.
Yeah, I mean, I do think the market is trading it as if we're on a downward inflation trend, and you might get some volatility in there. But I think, people will view this as still a downward trending inflation market. To your point, though, after last week's high print, after a strong payrolls, if you were to get an upside surprise, then, maybe the argument there is nominal growth is at a level where the Fed doesn't need to or shouldn't be cutting. So, big picture, I think you're going to need a relatively significant beat for that to happen. But to your point, accumulation of data, 2 in a row plus a strong payrolls report, could get people talking much more in that direction. But hopefully that's not the case. Hopefully we get a friendly print and we just rally.
I want to hear more about the wages as it pertains to earnings in particular, because if wages are on the rise, that is an input cost. And why wouldn't margins be more constrained in that scenario, especially with potential supply chain constraints here when you're watching what's going on around the globe?
Yeah, look, it's interesting. Coming into the year, that would have been your fundamental downside from an equity perspective, which is nominal growth declines, but wage inflation is positive. So you get this kind of tough issue where your revenue line is slowing, but your wage inflation is rising behind that, and you do get margin pressure. Maybe we saw a little bit of that last quarter, but the fact is earnings have just remained strong. So I agree that's a risk. That's sort of your fundamental risk in the background. But I think the market's going to have to see the white of the eyes on that one before they really react to it.
We're waiting to see the whites of the eyes starting on Friday, right? Mm-hmm. In terms of the big banks kicking off earnings season, Sonali is already preparing. Probably was curve. Last week.
The yield curve.
Yeah. So what do you expect from the big banks, and what do you think about sectors, industries? Where do you like?
Look, I think banks are going to be important, obviously, kind of set the tone for what they're seeing from a credit risk perspective and on the economy. But look, the earnings season is going to be basically October 24th to November 1st, give or take, which is when you get those large cap, tech stocks reporting. So last quarter, that number was a little bit.
Wait, are you poo-pooing the banks? He's poo-pooing the big banks.
Hey, listen, the yield curve being inverted into today and losing its steepener, I have questions too on how well they could do.
It's an issue. Obviously, I'm not going to get myself in a compliance issue by talking about banks a week ahead of earnings. Look, I think the four takeaways we care about this quarter. Number one is last quarter you had the 493 generate EPS growth for the first time in a year and a half. That's hugely important to the broadening trade. Banks, what are they saying about the economy and credit risk? Tech is a margin issue. And then really late in earnings, you're going to get an update on consumer spend. So those are going to kind of be the three things to talk about.
That's a good roadmap.
Yeah, and look, I agree. Like the twos, tens has become an interesting topic just because, in our view, once you get out of inversion, the market starts to trade growth. Once you get back into inversion, it becomes a much different game, both for the banks and for cyclicals in the market as well. So, twos, tens really important, and we'll have to just see how that decides to settle out.